Hey, this is Todd with YesTodd.com. I want to talk to you a little bit today about some of the next-gen homebuyer stats. So here's what we've got going on, which is kind of interesting. So when we look at the financial challenges and strengths of the homebuyer market today, one of the things that comes up is 70% of the next-gen clients that were surveyed had checked their credit in the last 6 months, which is important. So I want to talk a little bit about credit because I say this all the time. A lot of people think you get a mortgage on a house, but you don't. You get your mortgage on your ability to repay a loan, and it comes down to 3 boxes that need to be checked in this order. Box number 1, what is your history of paying people back you borrow money from? And that is the credit piece. That's the very first box. So that's what we're going to talk about a little bit today. So if 70% of the market is checking their credit, where do they go? Well, I would recommend that everybody go to myfico.com. And when you get here, you don't need to pay him any money, but you want to go to this education section. There's a lot of information here on how credit works and what it is. And essentially what I want to talk to you a little bit about is going to how scores are calculated. So when you click on this button, it's literally going to bring up what the credit bureaus are calculating in their algorithm in order to determine your credit score. Now, recently, and it changes all the time, but the average credit score in the U.S. is somewhere around the 716 marker. So that gives you a pretty good gauge of where you need to be credit-wise in order to be considered average, good, excellent, and so forth. So when we look at this, 30% is on the amount owed. And that's what's interesting is when you think about the quickest way to improve your credit score, it is to reduce the balances on revolving debt. So it's a simple calculation. If you've got a credit card and you've got a balance of $3,000 and the limit on the card is $5,000, you're at a 60% balance to limit ratio. So there's 2 things you can do. You can pay down that credit card. The other trick that a lot of people don't realize is if they've got a $3,000 limit and they were able to reach out and they always pay their bills and say, hey, can you double my limit? Go from a $3,000 balance up to a $10,000 balance, boom, they immediately drop this percentage of amount owed in half, and that will improve upon their credit score. Payment history is a really big one, making sure everyone is paid on time. I explain to people that I feel like credit trade lines, is what they're called, are basically relationships. And it's one of those things where if you were late on a payment, think about you're in a relationship and you were unfaithful. They don't forget that, right? Even if you close the account and move on and say, well, it's not part of my active trade lines anymore, it's still remembered that you screwed up back in the day. So you really can't get rid of that until you hit like a 7-year marker. So paying things on time is a really big deal, big enough that it is the most important on this list. The mix of credit between student loans, credit cards, car loans, mortgages, etc. matters, and the length of credit history and new credit. So new credit and length of credit history are kind of the same, but basically what this means is as soon as you start a new relationship or open a new trade line, a new credit card, etc., that hurts your credit score until you prove you've got the ability to make those payments. So your credit score will dip a little bit, and after a few months, it starts to improve. So the credit history is when a lot of people, when they don't have credit, but they get added as an authorized signer on somebody else's credit card, like a parent or something that has had the card for 20 years, boom, immediately they inherit this entire credit history of 20 years that's in good standing. What else is interesting about length of credit history is, let's say you had a store credit card, Target, Kohl's, Best Buy, whatever. You've had it for years and you just never use it. Because store credit cards are bad, you shouldn't have them in the first place. I don't care what kind of discount they're going to give you up front. In general, those aren't the good cards to have. Think about it this way. If you had a Best Buy card and you're out driving to the mountains and you blow a tire and you need to get a tow truck, you can't whip out your Best Buy card to use for the tow truck. It's not accepted. It's a store credit card only. You want to have the big ones, right? The Visa, MasterCard, American Express, Discover, that kind of card that is universal and can be used anywhere. That's all I need to tell you about that. But when we go to these length of credit history and the new credit pieces, let's say you've got this old Best Buy card that you've had for 10 years, you haven't used it. Well, they probably would have closed it on you, and you go into Best Buy because there's a date of last activity and you haven't used the card in 4 years. So there's a date of last activity. If you go to Best Buy, buy a new charger cable, let it run through the billing cycle once. What happens is all of a sudden that date of last activity goes from 4 years ago to current, and you basically inherit 4 more years of credit history with this relationship. Everything is still current and in good standing, and you see a pop in your credit score. So those are some of the things you can work on. I would go to myfico.com and spend a little bit of time looking through this, how credit works. It is one of the most significant pieces on acquiring debt in general. I tell all of my clients the higher your score is, the cheaper life is in general. And kind of my shtick is I want to find ways I can help people make their money work for them so they don't have to work as hard for their money anymore. And understanding credit is a big piece of that. So I would definitely spend a little time here. When we go back to this one, there was a slide here. Yeah, right here. Where did it go? Sorry, it's over here. That the main barriers to home buying are uncertainty about the future, but also a lack of financial knowledge. Well, that is very, very easy for you to overcome by simply educating yourself, by going to places like my YouTube page and also to places like this myfico.com and getting the information directly from the source. There's also another slide here about most people don't trust lenders. I know why. Because lenders are taught to sell you products whether they're good for you or not. And very few are into it for the long game where they're going to tell you not to do something because it isn't in your best interest, no pun intended, and wait until it is. So there's a reason why half of the marketplace doesn't trust mortgage lenders. It's because mortgage lenders can't be trusted. So you want to go to places like myfico.com and others to make sure you're getting the right information from the right sources and educating yourself first. If you need more information, you're always welcome to give me a call and I can help you. You can click on the link below, subscribe. I'll be submitting videos here and there throughout the course of the year to help solve basically this one right here, the lack of financial knowledge, and be able to help you out.